What's going on, everybody? My name is Big Al and I love my mama. And welcome to this edition of Financial Fridays. Now, what I want to talk to you about this week is what in the world is finance? I know a lot of people have a lot of different definitions of finance, and my definition is just going to be in my version. And my version of the definition of finance is flipping money. Listen to me. Finance just means you're borrowing money. In the world of finance, we're borrowing money at, let's just say, 5%. So we're borrowing money at 5%, and then we're going to invest it into assets and then earn money with a return on investment of 15%. So finance just means that we take money at one rate, we invest it into assets that generate cash flow that produce a return on investment at a higher rate. So our return on investment, ROI, is going to be 15%, and our cost, our rate, our interest rate, is 5%. In this situation, that means that we profit 10%. 10% profit if we're just dealing with rates of return. So now, the other component that we have to take into consideration is how much we invest. Now, if we invest $1,000 with a 10% profit, you guessed it, we make 100. If we invest $10,000, we make $1,000 of profit. Now, let's just say if we invest a whopping 100 grand, then we get to make $10,000 of profit. So there's a couple of variables that we always have to keep into consideration when it concerns making our return on investment. One of the variables that we have to keep into consideration is the interest rate, all right? Then the next thing to take into consideration is the time horizon. Next, the investment, and then after that, any payments we receive. So now what we start off with is this rate, 5%. This is 5% usually in APR, annual percentage rate. So if we're talking about time, let's just evaluate this over 1 year. The investment, if it's a $100,000 home, let's say we put 10% down, that's $10,000 of an investment. And then the payments that we receive, let's just say if it's a $100,000 home, we're probably not making a lot of rent off of it. Let's just say that it's $750 rent. But then of course we need to subtract payments, $400. I have to pay another $75 in property management. I have to pay utilities, taxes, etc., etc. We'll call $450. Or principal, interest, taxes, and insurance. $75 property management. Say another $100 another. So now that's $575 minus or from $750 puts us at like $175. So let's take this a different route. Time horizon, let's just say 10 years. Why 10 years? Because an economic cycle is usually 8 to 10 years, meaning historically a recession happens every 8 to 10 years. So that's why we call it economic cycle. The ebbs and flows of our financial situation as a country. So the investment. So the time is 10 years. The investment, let's just say it's $10,000 down payment. So with a $10,000 down payment, we receive payments equal to, if we will get $750. And when I'm talking about payments, I'm talking about net cash flows. So our income minus all of our expenses. So let's just say in this scenario, we make $250 a month in profit. So $250 a month yields about $3,000 a year. So now over 10 years, we've received $30,000. If we were to sell this property, let's just say we bought it, sell this investment, we put down a down payment of $10,000, we sell it at a profit of $50,000 10 years later. So then we have an extra $50,000, and let's just go ahead and take taxes out of that. So we'll drop it down to $40,000. Now we've made $70,000 of income on a $10,000 investment, but that's over a 10-year period. Time value of money, we plug it into our equation, and we make some money.